Hey everyone, how you doing today? Hope you enjoyed episode number 2. Really enlightening. Drop and swap. That's something I had never heard about. So go check that out if you haven't. It's eye-opening to think about the things that might be coming or things that have been done historically. But here in episode number 3, we're going to hit a smorgasbord of topics. First, why don't we hit the Fed? So the Fed came out, had some talks. I don't know, Jonathan, if you've had a chance to read what they had to say, but basically they're still not thinking about raising rates.
Yeah, the Fed came out yesterday, said they're keeping rates at zero for the foreseeable future. And when asked about inflation, uh, that said basically we don't think there's any inflation problem. We think that there have been supply chain obstacles which are causing temporary price dislocations and temporary bouts of inflation, but as things open up, those will work themselves out. And now I agree with them and I disagree with them on this. I do agree that what they measure as inflation, consumer price inflation, is probably exactly as they say. I think there has been a lot of demand for certain items that's caused inflation. People have gotten stimulus checks. That means more money in their pocket. And there have been bottlenecks, right? The thing is like, you only need one washing machine, right? Yeah. You go buy a new washing machine, you buy it and you're done. If you use your stimulus, it doesn't, it may temporarily cause the price of washing machines to go up because more people want them. Yeah. But then what's going to happen is everybody will have bought them and then you'll have a washing machine recession. Like literally you'll have a recession.
Yeah, there'll be a gap
for the washing machine manufacturers because they'll have exhausted their entire market until people's washers start breaking down again, right? So the prices will go down, right? And nobody will talk about it or notice it. So there's that. And there are also supply chain problems because people have, if you've tried to buy furniture, for instance, in the last year, right? Yeah. The factories were shut down because of COVID, right? So it caused a lot of problems. Lumber, right? Same thing. Yeah. Sawmills shut down.
Hey, Jonathan, your microphone's hitting your shirt a little bit.
Oh, I'm sorry.
That's okay. That's all right.
So, yeah, so those things are all, as COVID winds down, those price dislocations.
Yeah, I still think the Fed's looking at the wrong spot. So I get all of that. I econ guy, watch the numbers. I think this is what's going to surprise the Fed, and they're not talking about it yet. That's labor. I see labor getting more expensive. I see labor inflation.
Well, now, I want to talk about something else, but let's talk about this first. Yeah, So listen, I think that could happen, but as a real estate investor, that's not really a bad thing, right?
Oh, I didn't say it was a bad thing.
Yeah. So I think and there was a big special in The Economist like 2 weeks ago about how The Economist is basically predicting that, look, over the last 40 years, the pendulum has swung towards management, right?
Yes.
And away from labor. And now they're saying it's swinging back. And
I agree.
There's a lot of things, not just COVID. I mean, one of the things about this article is not just COVID. It's just a lot of other things where the pendulum is now swinging back towards in favor of the worker, which means the workers are going to get a bigger slice of the pie.
Agreed.
So the people who own companies, shareholders might not like the fact they're going to have to pay more for labor, but for everyone else, and especially for owners of real estate, like, boy, a little wage price inflation is good for you. I mean,
it's not a bad thing. Yeah.
It's not a bad thing at all. That means you can raise rents.
Yep.
It means your tenants can pay rents more easily. I mean, this is like a good thing for you. So,
okay.
And especially if you're like a small landlord, you don't have to pay your own labor costs, right? It hits the multifamily sector a little more because now suddenly, like your HVAC certified tech, head tech can now demand higher wages from you. But frankly, in the grand scheme of things, if you own a 200 unit property and you got to pay one guy $5,000 more a year, like it's noise.
Right.
So, and if all your tenants are paying more rent, like, hey, you take that deal any day. Right.
Yeah.
So, but it's even better for the small people who are not having to pay for labor, right? So
Sure.
so that's all good. Now, where I disagree with the Fed is I think that they're not measuring the right stuff, because
Yeah,
they're
that's true.
they're,
Yeah.
they the consumer price index does not take into account people's largest expenditures, which are housing,
Hmm.
health insurance, things like this, where the prices are skyrocketing.
Yeah.
And they also don't take into account investment assets. The Fed has sort of taken this position that, oh yeah, we know that if we reduce interest rates to zero, you're going to have massive asset price inflation,
Hmm.
but it's not a problem. In fact, that's good because it creates the wealth effect, which means people are going to feel richer and go spend more money in our consumer economy. What they're not thinking about is how this affects, the rising cost of real estate affects people's ability to buy a house. It affects the rents that they have to pay. It's taking, maybe there's a wealth effect. It creates winners and losers big time. If you already own the real estate, boy, are you happy that it's worth more now. But if you don't own if you're trying to buy real estate, if you're trying to rent real estate,
Hmm.
now you have a negative wealth effect, right? You've
Yeah.
got to pay more to someone like you or me in order to um, live somewhere. And
Yeah.
so it's sort of taking essentially, it's like robbing the poor to give to the rich, right? It's like
Mm.
reverse Robin Hood.
Hmm.
And so, and frankly, I don't think, like I said, if you own it, it's great. But even as an investor, now you've got to go and pay a 5 cap for something that you were always able to get for an 8 cap. It
Yep.
makes it harder for you to make a living as an investor
Yeah.
when you have this kind of asset price inflation, right? So, I don't think. I mean, frankly, I think, like, I'm getting off on a tangent, but I mean, I think that the Fed, you know, and the federal government, because they're working, the Fed has to make sure the federal government doesn't go belly up, so it's keeping interest rates low. Plus COVID is their justification, but
Hmm.
you know, interest rates have been ratcheting down in a one-way direction for decades, and it's
Yeah.
because it's related to the federal debt,
Sure.
and that has basically made it impossible for people to ever save enough money to retire. Right? You
Yeah.
can't. You
You
can't
have to
like.
invest now. You can't save your way to retirement. Yeah.
Well, not only that, but even investing, right? Even investing, you can't go and like buy property at an 8 cap right now.
Yep.
Let's just think about, like, it used to be the case, if you had $1 million, you could go buy a building at an 8 cap and generate an $80,000 a year income, right? Which is, in a lot of parts of the country,
Hmm.
that's enough to live on
For sure.
comfortably, right? Now that same $1 million only gets you a $50,000 income.
Yeah.
You have taken a $30,000 pay cut, right,
Hmm.
on that $1 million of investable,
Yeah.
investable asset, and it's just, and so it's made it impossible for people to kind of like retire. Frankly, like, they're
Yeah.
just, it's going to be very, very difficult for most people to ever generate enough retirement income to retire. So, um, again, we talked about the way that government policy distorts the economy. This is one of the biggest, and it's one of the most kind of pernicious, because it doesn't seem like a bad thing. Like,
Yeah.
low interest rates seem like a good thing. Everyone, investors are always thrilled about low interest rates, but the problem is the market arbitrages that advantage away very quickly.
Very quickly.
Right?
Yeah.
So,
Yeah.
like, it was great to invest in 2012 when cap rates were 8% and interest rates had plummeted, right? But it was only a matter of time. But you had to get in then.
Get in
Eventually,
fast.
the
Yeah.
market adjusted to the new equilibrium,
Hmm.
and it basically took that advantage away. And
Hmm.
now, and on top of it, everybody is like, so people are now jumping into investment assets because they're worried about inflation,
Right. That's
right?
where we're going next. That's right. We're,
But
we're seeing a buying frenzy or an investment frenzy because people fear inflation. I just wanted to set
right.
up the next topic. So go ahead.
Yeah, so people fear inflation, but I think, like, the conversation is a little bit skewed, because when they talk about inflation, they're talking about consumer price inflation and the erosion of their dollar, but that's really not happening. what's happening is the inflation is in assets, and it's really more about like fear of missing out, or legitimate fear of missing out,
Yeah.
because you got to get in, because if asset prices are continuing to rise, then you've got to get in earlier rather than later.
Yeah.
But the problem is nobody knows when the music stops. Like if all of if you know, if people, me as a multifamily investor, I wanted to invest for cash flow,
Yep.
right? And cash flow is kind of like the discipline, like that's the metric that keeps you disciplined
Yep.
for buying a deal. It has to produce X return, has to produce X cash coming off of it. And if it doesn't, I'm going to look for the next deal. The problem is the Fed has basically made that almost impossible, because nothing generates enough cash flow anymore. You have to chase, you know, the ever declining yield. And essentially what people are looking for now is it's asset inflation, and that's how they're going to get the return.
Yeah.
The problem with asset inflation is it only goes it goes on as long as it goes on. It's liable to stop. It's liable to just end when something in the economy happens and people's risk appetite changes.
Yep.
Right. So unless now they've taken the position that no matter, and I know people who think this, that no matter what happens, the Fed will bail us out.
Oh.
So it'll, you know, if the economy at zero interest rate slows down, well, they'll go negative. And that may be true, right? But basically what's happened is the whole real estate investment market has essentially become a casino, right? You're just betting on on appreciation. And that's why what you're seeing in multifamily is, and I've talked about this before, the value add property that's been sold as a value add now the second or third time in this cycle, right? And somebody comes in, they buy it, they renovate 20% of the units, they put it on the market as a proven value add. Say I renovated 20% and prove that the rent bumps are there. Now you buy it. By the way, I'm going to charge you, you're going to pay me the post-renovation value, and you still have to do the renovation, but
don't worry,
you'll make your money. And then that person goes in, they renovate 20% of the unit, like the next 20%. They realize the returns aren't there on a cash flow basis. So they put it on the market, right? Same thing. We've renovated 20% of the units. Oh, by the way, you have to pay us, you pay up for the privilege.
Yeah.
That can only go on so many times before, you know, the whole thing collapses. So, but that's what you're seeing. Like cash flow investors have become flippers essentially, and you're seeing, and they're saying, you know, to their investors, well, look at the IRR generated for you, which is true. Like hey, they can, because they sell fast. That's
if they can
IRR.
get out, if they can get out.
Yeah. If you sell fast, of course you can generate a high IRR, right? Because an IRR is all about the time value of money, right? Exactly. It's not about how much cash you put in your pocket. It's not about the return you got. It's about how fast you get your money back, right? So you can generate big IRRs by flipping fast. But for all those investors who are like, hey, I wanted to have my money earning interest for me, you know, for 10 years, I wanted the cash flow. Well, great that you got my money back, but now what am I going to do?
Yeah, what do I do now? Yeah, you know? The music's going to stop. I've been in this role before. It doesn't feel like it's going to stop, but it does. Last time it was houses. It's going to be value add multifamily. It's going to happen.
But houses too. Did you see that we're now at bubble level prices for single family houses?
We are, right? But we're not at bubble high for payments, and people buy on payment, right? That's the difference.
I mean, this is a little bit off topic, but I wanted to ask you this question. Because I was thinking about this morning. You know, the last housing bubble.
Yep.
You know, you had this phenomenon where, and I think what's happening now is different from then, right? But you had this, people were going crazy, speculating, flipping, and you heard these stories of people who were like, you know, because they had these no doc loans or whatever.
Yeah.
People owned, you know, they bought, like, you know, people who didn't have that much money, 5, 6, 7 houses. Like nobody had any problem buying houses. It seemed like they were, as crazy as the market was, like people could get their hands on property.
Absolutely.
Now though, you know, it seems like the demand is being driven by other factors, one of which is the need for more space. That's like a legitimate, like owners want to buy.
Yep.
Right. So that's like legitimate demand. You've got, and obviously you still have, and you have the investors too, who are out in more force than ever. So there's like really legitimate demand for this, but nobody can get their hands on property. So what's the difference? Like, why is it that, and I just don't know the answer to this. So I thought you'd be.
So we have a couple of Yeah, so we really do have a supply problem. So the first problem is for a year, the people that would have normally sold and upgraded, right? We basically missed a year of trading up, right? The people that bought 10 years ago, they'd been in the 1,200 or 1,400 square foot house, had another kid, needs more space, got promoted, wants to live on a golf course now, whatever. That whole year was missed. They painted their house. They changed the fence because they didn't want anybody to come in and touch their stuff. Now we're right on the cusp of what I believe is going to be a doubling of inventory because you have that whole year and they have appreciation. Now they're like, oh my God, people look at their houses like piggy banks and they're going to start to list. But I think the first step is going to be the contingency sale because right now they want to sell their little 1,400 square foot house, but they can't buy anything. So I think what's going to happen is you're going to have a lot of contingency sales. Yes, I agree to sell mine, but I've got to buy one first. So that daisy chaining hasn't been very common for a couple of years, really since the last environment. I think that's what we're about to see. Inventory is already coming up in my market. It's still nascent, but I see it because I look every day. So I think we're on the cusp of inventory showing up. But really, people are stuck in their homes. Even if they want to move, they can't because the upgrade's not available. So
that's been a problem for a while, though. I mean, even before COVID, like I think in a lot of
it's just
like,
exacerbated. We're at a million. We're at a million available homes, and we should be at 3.3. That's just remarkably low. And that's all homes. That includes all the $10 million homes and all that stuff, right? If you go down, because I segment my market now. So my market median is like 360. So I try to look at 250 and below. We're talking 3 or 4 days of inventory,
wow.
right? I mean, that's just nuts. So that's what I think is going on. So let's do one more topic here. We wanted to do the distortion, right? 1031 distortion. Yes. So educate us on why 1031 distorts the market.
Yeah. So like I mentioned in the last segment, you know, when your fish doesn't know it's swimming in water, right? When you exist in an environment that has certain rules to it, you think that that's just the way it is, and you kind of adjust your plans accordingly. You don't think about it very much. But what I believe is that the ability to first, you know, take depreciation on an asset that is not actually depreciating, right? It's appreciating, and obviously you have maintenance and you've got to keep it in shape, but it is growing in value over time. But you are allowed to pretend that over the course of 27 and a half years, your property will become obsolete and worthless, right? And you'll have nothing left of value but the dirt on which it stands. But you were allowed to engage in that fiction. And that is sort of like the seed of all the problems, right? Because, you know, the idea behind that is, well, we want to encourage people to invest in their properties and keep them up. You know, that's fine. But there are, I think, a better way to do that. And we'll talk about that in a minute. But so the depreciation problem, you know, not a problem, depreciation availability, you know, now if the government had said, yeah, we're just going to let you depreciate this and that's the end of the story, you wouldn't have a problem. But what they do instead is they say, okay, well, we've got to make this revenue up somehow. So we're going to charge you recapture tax at the end. Right now, it's still a benefit because you're paying money A later and B at a lower rate, right? So you still have a big tax advantage. The problem is it all comes at a big lump sum at the end, right? And that creates a cash flow problem. And especially if you have refinance. Now, if you didn't refinance, you are probably going to have enough cash to pay it. But frankly, who wants to pay all that tax? You know, you've just made this big sale. You're really happy. You're counting your profits, and then you realize, like, oh my God, I
get a lot less than I thought.
all this tax. Yeah. So the government has then said, well, look, we're going to solve this problem for you if you do something for us, which is, you know, provide more housing.
Yeah, go bigger.
So go bigger. Now, that would make sense if you were to go and like build new property, but you're not. You can just go buy new property and start the whole game over again. And so what happens though is that so people can't resist the temptation to refinance their deals and take cash out. And oftentimes that is their goal. Like in a rehab situation, you go and you refinance and you take cash out at the higher value. or, if you own commercial property and you have to refinance every 10 years, it's awfully difficult to say, you know what, I'm just going to refinance the outstanding principal
Hmm.
and not take any cash out, even though my property is now worth twice what it was. The problem is when you refinance and you've got the recapture tax that you owe and you've got capital gains tax that you owe, you can very well wind up in a situation where you can't afford to sell, right?
Yeah.
So because the tax bill is too great. So what happens then is that people wind up being desperate to buy new property and they overpay for the next property. And in general, if they're looking at things so there's those people who are literally overpaying for property, and you have a situation like right now that is exacerbating the problem with asset prices because people are selling at all-time highs to capture their gains, but then they have to buy replacement property, and they will overpay for replacement properties just to avoid the tax, and it's causing a distortion in the market. It's causing the prices to be higher than they would be other than if you had no 1031, right? But also in general, since people are, rational investors are thinking about what their after-tax take-home is, and that's how they're investing, not just for, what the nominal gain is, but it doesn't matter what you make, it matters what you keep, right? But since people are thinking about what they're going to keep, and what they're going to keep depends on various tax strategies, the more tax advantaged it is, the more they will pay for the asset, right? So that causes prices to go up higher than what they would be without the tax advantage, right? So there is a distorting effect of depreciation and 1031 on real estate. Now, what I would say would be a better, and not only that, but it's complicated, right? It's complicated, and I didn't even know this, but 1031 opens the doors to fraud, which I've never even heard of before. But I've heard of investors who, there was a big Ponzi scheme several years ago where a 1031 qualified intermediary was pocketing the money.
Oh my God.
Right? So, and the guy I think has gone to prison since then.
I hope so. Yeah.
But who even knew that was a risk? But apparently that is a risk. So, but this overly complicated scheme where you have to go through a qualified intermediary, so you never take possession of the cash, which is why then you don't need to be taxed. The government could just do away with all that stuff and make it simpler, but it doesn't, right? So, but that aside, a better way, in my view, if you wanted to encourage people to invest in their property, would be to just let them expense it when they do the, so rather than having, items where, this is maintenance and this is CapEx, and this one you can deduct right now, and this one you have to capitalize and deduct over time, and all this kind of stuff. If the real intention is to encourage people to spend money on their property, right, then just let them deduct.
Yeah, in the accounting world, we call that cash accounting, right? Cash goes in, cash goes out. You just deduct it 100% once the cash leaves. So it's cleaner.
Yeah. And so that would, if people could have years where they have a tax loss because they spent money on their property and they didn't have to spend, it's not after tax, it's pre-tax for them.
Yeah, true.
That would achieve the same thing. And then you could just do away with all the rest of it, right? Yeah. So don't have any of this, depreciation and then recapture and then 1031.
Oh my God, the tax code could get simpler. You're crazy.
Yeah. But, and I think honestly, like when all of these things were invented, right? The depreciation allowances and 1031, the country was like, I think some very small proportion of people actually own their homes. Like now we think this is normal, like 65% home ownership.
Yeah.
That's because the government has pushed home ownership for decades.
Yeah.
It used to be
30-year loans weren't a thing back then. They were 5 years or something. Yeah.
And in many countries, like people are shocked that you can have a 30-year mortgage. Like in lots of countries, you can't get a 30-year. You can't get any mortgage.
Certainly fixed. No, you can't be fixed for 30 years. Yeah.
So you know, or in other countries, you get saddled with like these like Switzerland, the 99-year mortgages, right? You have to
Yeah.
pay the mortgage forever. So the 30-year mortgage you couldn't get it before Fannie and Freddie. It didn't
Yep.
exist.
Didn't
Banks
exist.
did not give 30-year mortgages, right? So again, it's like everything else. You know, well, first of all, the thing is, most people used to be renters, right? Most Americans were renters 100 years ago,
Mhm.
right? So when a lot of these accounting rules were passed, it was like for a very small number of people
Mm.
who, you know, and they're kind of like, and there was a lot of problems with like slum properties and all sorts of stuff that was trying to fix the problem.
Mhm.
You know, now those problems don't exist anymore, but you've still got the tax code. It's sort of the, you know, it's the law of unintended consequences, sort of where we wound
Sure.
up with this, right? So, you know, there's that too. And the 30-year mortgage has distorted the market, right?
Mhm.
You know, you pay more for a house now because you can get a 30-year mortgage.
No question. Well, just
And you
wait.
pay,
I think one of the things that comes out of this is a 40-year mortgage. I think what we're going to see by next year is quotes on 40-year mortgages.
you may well do it. I mean, look, HUD financing is becoming a big thing in multifamily right now because HUD does 40-year loans at 40-year amortization.
Oh,
Right.
wow. I did not know
So it's great if you can get one, but of course, when that becomes the norm, it's just going to kick the price up higher because everybody will just calculate, you
based on
know,
that.
based on that, and you'll be able to. And at first, you know, at first it'll be the people who can get those loans will have a bidding advantage, and they can bid just a little more, but they'll make a
Mhm.
lot more money. But
Right.
like everything, it gets arbitraged out,
Yep.
right? So eventually, that will become the norm, and you'll just be paying more for your multifamily
Wow.
property because you're competing with the people who can get HUD
Yep.
financing. And so, you know, and then Fannie and Freddie will have, you know, it's all going to change. Like Fannie and Freddie will have to compete, and then
Yep.
they'll go to 40-year amortization,
Yeah.
and you know, it's never ending.
Oh man, this is going to be fun. Well, you know, real estate investing is never boring. I think the next, I don't know, several months, 2, 3, 4 months, while all these negotiations are going on, are going to be fun. So, Jonathan, I appreciate your time this Thursday. You have a wonderful day.
You too, Michael. Take care.
Thanks, buddy.